investors continue to digest the implications of the British EU vote for the global economy and European politics. I want to bring in Charles Schwab's Chief Investment Strategist and Senior Vice President, Ann Sonders, with her take. Ann, good to see you.
Nice to see you.
Thanks so much for joining us.
My pleasure. Thanks for having me.
Take us back. Over the last couple of days, we saw an immediate reaction in global markets. What, from your standpoint, is the impact of Britain leaving the EU?
Well, we don't know yet. John made a good point that in terms of the market reaction, probably not a stretch to say it's a little bit overdone, but a lot of it is just reversing not only some of the gains earlier this year, but the gains heading into the vote on Thursday. You saw a massive move up. So at least Friday was really just a kind of give back of some of those gains. We obviously went beyond that yesterday. We don't know the economic impact. There has not been a lot of broad downgrades to economic assumptions. That said, even if we come down, we're coming down off of a very low level. So this certainly doesn't help us get out of this sluggish growth environment, but I don't think anything would have.
What will drive things in the second half of the year? Is there anything out there that could get this economy and get the markets going? Or are we talking about just continue to slog through?
Well, I think if we saw business investment kick back in, we've started to see the growth rate change.
Why should we?
Well, I actually think I don't want to use the word blame. I'm not a Fed basher by nature, but I think the Fed has done more harm than good as it relates to the confidence channel for businesses. And I think treating the economic patient like it's still in the trauma room, I think has been part of the reason why business investment has been so weak. It's a perfectly rational decision that businesses have made to not invest long term, but instead take advantage of low interest rates to buy back their own stock, and that's been the primary support under the market.
But the Fed, you say the Fed keeps talking down the economy. Every year they have growth forecasts for close to 3%, and every year we get 2%. They're reacting to the same bad economy that it seems to me investors, that CEOs are reacting.
Which is why there's such a yawning gap in the dots plot between what the market's assumptions are looking forward and what the Fed, and we still think the Fed has to come down, and then that gap will narrow in the out years, 2017 and 28, by the Fed coming down more than the market goes up. But you know, if there's one benefit to what has been an incredibly sluggish recovery, really from the outset of this recovery, is that you don't build the excess that tends to tip you over into a recession. So I actually think we probably avoid recession, not because I have an optimistic outlook on growth, but we haven't built the excess, whether it's investment excess, monetary policy.
How about
excess.
Inventory? Stephanie Pomboy was just on here saying there's a huge inventory overhang.
That's been a drag. That continues to be a drag.
So that's why she thinks we're actually going to see a recession second half of the year or 2017. The inventory backlog, along with what you mentioned, the business spending.
I think we're more likely to stay in this sub 2% below trend kind of environment than go into it. So we're in an earnings recession. And I think the only turn there comes if we don't see this renewed rally in the dollar persist. Because then, under those circumstances, I think the bottom in earnings was in the first quarter. We don't move back into positive territory until later this year, but inflection points matter more for the market than absolute levels. And better or good matters more than, better or worse matters more than good or bad.
So should you be buying stocks in an earnings recession?
At some point, actually, interestingly, the best environment for the stock market has come when earnings are in the negative 20% to negative 5% zone, which is surprising to a lot of investors. One of the worst times to be buying the market is when earnings are growing at more than 20%. Now, it's because of that idea of an inflection point. When you come up off a low and you're accelerating, that's your best opportunity from a market perspective.
How can viewers know when we're at that inflection point?
Well, we don't. And that's the problem, because by definition, an inflection point, whether it's an earnings inflection point, whether it's an economic inflection point, think of March of 09.
You've got to give them something to hang on.
When you're in the dot, by definition, at the bottom of the V, you're at the bottom. So the absolute data looks its worst. It's figuring out that turn. I think
it's about now, right?
Well, maybe not. I think Brexit, obviously, and the uncertainty associated throws a wrinkle in
and
that.
The election makes people step back.
That is absolutely a factor. Not only because this is an open election, we don't have an incumbent, we had a two-term president. Those have historically been the worst year of the 8 in an 8-year cycle for the market. I would argue that the uncertainty associated with this unique election may be a tad a scotch higher than your normal open election.
Oh, is this a unique election?
Just in
Maria. Ann, good to see you.
Thank you very much.
Thank you so much.